So tonight we have Jason Smida. Jason is a certified CPA. And what does that mean, first of all? So are you like certified only to work in Pennsylvania taxes, or can you work for other states and that sort of thing? How does that work?
Yeah, so the license is on a state-by-state basis, but I can work in any state. I just can't, if I advertise in another state, I can't work in that state if I advertise. It's a nexus thing, without getting licensed in the state. So like Ohio, if I went over across the border in Ohio and started advertising, I'd have to be licensed in Ohio. But if somebody calls me from Ohio and says, would you mind doing my taxes or books or payroll, I can do that.
Okay.
I just can't go out and advertise in that state as a CPA.
Okay. Cool. So your knowledge is relatively broad, I'm assuming. Like a lot of the the tax law that's super important is federal law, right? So how long have you been doing this?
I've been doing this since 2009 and certified in 2011. So going on 12 year, yeah, 11 years now.
Okay.
Boy, that goes fast.
Yeah, I'm at 15 and it seems like it was just yesterday.
Yeah, I remember a year to take the test because they do it in 4 parts. So every quarter you got to take it. And I remember a lot of sleepless nights studying for that.
All right. So tell me your story. So were you always in accounting, or like where did you start and what led you to the CPA status?
So interesting story. A lot of my family didn't see this coming either. I mean, I kind of played around in high school, so it wasn't, I was bored in high school, so grades weren't great. So when I graduated from high school, I didn't go straight to college. I ended up managing a auto parts store. I have a love of cars, fast cars. And then I had my son, whose picture is back here. He's 21 now. I had him when I was just 1 month before I turned 21. And I'm like, I really need to get my butt in gear. The management job pays okay, but I want more. He needs more. So at 22, I started going back to college. I worked full time, and then in the evenings went to school. And then graduated when I was 26, and then went right into my MBA. Spent a month in China learning some international business law as well. Came back there, and 2 years later had my MBA. And then went to worked at Mellon for 1.5 years and realized that's not where I want to be. And then got a job with Schneider Downs, which is a regional accounting firm in Pittsburgh. And then studied for my CPA there, got it, and then decided I want to go work with small businesses. We worked with bigger businesses, but I wanted to have more face-to-face time with the owners, not like the CFOs. I wanted to with the owners. And so I found a small firm in Carnegie, worked with them. And then about 3 years later, they were starting to gravitate to mid-sized companies. And I still wanted to stay in the small business realm. So I ended up leaving and starting my own in 15. And that's May 12th of 2015 is when I officially started the company. And then in 18, we changed names. Now we're at Infinity, and brought a partner involved. And Infinity actually came by a name that I used. I did a business plan for an accounting firm for my senior project. And I'm like, well, it's time to bust out that old project and see what we can do with it. And that's kind of how the name stuck. And the name for me is kind of funny because at the time I didn't want to pay somebody to do a logo for the business, for the project for senior year, because senior don't have much money anyways. So I'm like, the figure 8's a perfect example, the figure 8 for the Infinity. I'm like, we'll use that as a symbol. And that was it. And that's how the name.
Okay. So Schneider Downs, I actually have a friend that works at Schneider Downs, and he's been there forever. And he's been, when I talked to him about it, he's like, oh yeah, I'm gonna retire here. Like it's a uppity place. So you moved on from Schneider Downs, and it was, you wanted to deal more face to face, get in with the smaller businesses and not be on that bigger corporate level, huh?
Exactly. I mean, I've talked to probably 7, 8 small business owners or people that are just starting up businesses a week now. And I mean, I never had that opportunity there. So I really like that, because you're not just talking accounting, you're learning about what they want to do for their kids, what they want to do for the rest of the life. They're putting a lot of trust in you. I mean, this is their livelihood, and it's a humbling experience, but I'm very grateful to be able to do it.
Good. And so you said you deal with like a lot of smaller businesses. Would you say that that's your specialty, or what would you say that you have a specialty?
We're really, before we started this, Dustin, I told you, we're about 60% real estate now. And I mean, that wasn't something that I planned for. It just kind of happened. And a lot of it's because we were doing these classes for startups, and everybody, it doesn't matter where you are, somebody usually gets into real estate. If you have a business and it's making good money, somebody's buying some real estate. And we just got good at it. And that's kind of how it all moved into that.
Okay, awesome. So what we'll do tonight, guys, I'm going to keep kind of grilling Jason with questions, but when we get towards the end of this, I am going to open it up so you guys can ask, whatever you want to know, any questions that you have for Jason about, his business or your business. So we will get into that towards the end. So if you have something that you're thinking of, write it down, or make a mental note of it, because we will get to that. So Jason, and to full disclosure, Jason does my taxes for me for pretty much every business that I have ownership in, and I've been dealing with his company for what, two and a half years now.
Going on two.
Yeah, and like my story is, I think Jason is maybe my fourth accountant. So, and
hopefully
I have
the
a
last one. Hopefully that's where it stops.
The last one. And I have a pretty high bar for what I expect. And I actually had a couple bad experiences with accountants prior to meeting Jason. And my first accountant was actually not an accountant. He was a scam artist. And he ended up costing me at least $60,000 so far, and he's still costing me money. And that it's been probably at least 8 years since I had dealings with him. My second accountant cost me about $30,000 in losses, and I only dealt with him for about a year. My third accountant was actually pretty good, but he was extremely expensive, and he didn't want to spend any time with me. So that's why I'm with Jason now. And what I get from Infinity Accounting is somebody that's knowledgeable and who's willing to kind of like say, hey, hold your horses. Let's take a look at this, because this could cost you a lot of money if we do it wrong. So Jason and I talk regularly, and if I have any questions about anything that, any decision I'm about to make, I take it to him first to make sure that it's not going to affect me in a super negative way as far as tax liability goes. So that's full disclosure. So that in mind, Jason being a specialist in real estate professionals first and foremost, and then also dealing with small businesses, if somebody were to come to you and say, hey, I'm about to open my first business or this new business, just kind of what sort of blanket advice would you have for them on the tax side of things in order for them to kind of prepare that small business for tax purposes?
And Dustin, if you don't mind, I'll fill in another thing I'll say too before we even look at taxes, is that when people come to us about, hey, I'm looking at starting, or they just started, the first thing I say is form a team of professionals. You want an accountant, you want a lawyer, you want an insurance person, you want a broker. Because the big thing is, you want all those people talking to each other. You want a team. You want everybody talking, everybody communicating, and focused around the owner. Because what I think is good for taxes may not be good for legal purposes. depending on structures. What I think good for taxes, the insurance guy might be saying, no, you don't want to do that. And then a broker too, retirement funds, healthcare, HSA funds, those type of things need all that. And those are things that I use, instruments I use to help offset taxes as well. The second thing I would say is, and this is a big one, and not always in real estate, but it does help depending on what you do. Entity structures. Everybody goes with LLCs. And I think LLCs are the best way to go. But then on the federal side, you can take that LLC and make it a corporation. You can make it a partnership. You can make it an S corp. You can have a single member LLC. Those entity structures really help on the tax side. It's like one example is when you flip. If you have a person that wants to flip homes, if you do a flip once in a while, it's capital gains, and capital gains are the most favorable tax rate you can get. But if you make a habit or a living out of flipping now becomes an ordinary income, so it's at the higher rates. And when you flip, if it's under the wrong type of entity, you're looking at paying twice Social Security, twice Medicare, and then if your state of PA, local is attached as well. So if we convert that to an S corp, you lose the Social Security taxes that you have to pay, you lose the Medicare taxes, and you have to pay local. So it's the entity structures are really a big thing that we start talking about when we first start talking to people. And also, the other big thing is start keeping records, even if you're thinking about business. So real estate's a good example of this. So we have a few clients that they start looking at properties. They hire a lawyer to start looking at the sales agreements. They have mileage associated. They have classes they've taken, but they haven't formed a business yet. They'll scrap those expenses. Oh, well, my business wasn't started up yet, so I can't take them. It's not true. Those are all startup costs. We don't need the entity to be up and running before we could take those expenses. We can put those expenses into the entity as a startup. So it's just, as soon as you even start thinking about business, start keeping track of those expenses.
Yeah, that's super good advice. And that's something where, when I started my first businesses, I had no idea about that. And a lot of it, I did not get the tax write-offs I should have gotten because I was just saying, well, I'll deal with that later. And, time flies, right? So you end up a couple years into it and I didn't even form my sales entity until 2013. And I had been doing sales since 2008. So that's a lot of potential write-offs, and I wasn't even working with an accountant either. So it was like, if I would have been working with somebody from the get-go, I probably would have saved tens of thousands of dollars in tax liability by, being prepared in the first place.
And Dustin, if I may even add to that too, the other thing too we say is, business ownership is great for tax deductibility. If you're an employee, you get to write off nothing. But as a business owner, we can start looking at your everyday expenses, your cell phone, portion of your cell phone, your home internet. Your home internet, if you're running a home office, does not have to be allocated based off of square feet like your rest of your utilities, because internet controls a lot of business anymore. In real estate, you're doing investigations on properties, you're reviewing properties, you're emailing, you're communicating. The internet can be a different portion. And IRS will let us anywhere between 60 and 80% of that internet deduction, and they won't even bat an eye on that. So we start looking, it's like, I had one lady, she was upset because she's like, I can't deduct my clothing and I buy all these clothing. Like, just put a logo, put your business name on it. Now it becomes promotional. We can deduct that now. So it's taking those advantages of running a business and seeing what we can take now as deductibility.
Yeah, and I always tell our agents, if you go sit down with and have a cup of coffee with a potential client, like, yeah, you can't write off the whole thing anymore, but you still can write off some of it. So you should be tracking all of that and making sure that you're getting the maximum deduction you can.
And in the state of PA, you can still write off 100%. PA, it's one of those rules where the state and the feds differ.
Yep. Okay. You kind of touched on this already. As far as entity structure goes, is there like a catch-all entity structure that somebody should be starting with, or how would you recommend as far as entity structures?
It depends. So it depends. So a lot of times in real estate, what we suggest is, and it's a comfort level. So if it's a one owner person, usually there's a parent company, and underneath that parent company, and this is just real estate rentals at this point. I'll touch base on what you should do with flips, but have a parent company hold the ownership in these other single member LLCs, so they're 100% owned by the parent, and each of those entities hold a number of real estate property or a value, and it's really, again, it's a comfort level, but maybe you say, I'm okay with $300,000 worth of assets in an LLC, or maybe it's a number. Maybe I'm okay with 5 buildings in an LLC. And once you get to that cap, create another LLC, hold the properties, because the limit liabilities, if you got sued and insurance don't cover it, that LLC, whatever assets are held in that LLC is up for grabs for liability. So if it's $300,000 worth, that's what you stand to lose potentially. But if you say, well, on an LLC, I'm only going to cap it at 100,000, that's what you can lose there. So it's really a comfort level, and we see it between number of properties or value of properties. Now on flips, and I'm not an attorney, but an attorney I learned this from an attorney a couple years ago. In the state of PA, if you flip a property, my understanding is that they have 2 years to come back on you. They could sue you for anything that they have an issue with. So what he suggests is you have that parent structure again, and each flip is put into a single member LLC. So let's say LLC Dustin 1 sells a property, but Dustin, your parent company owns Dustin 2 and Dustin 3, and it each has a flip in it. You sell one, and a year and a half later, the people that bought one comes back to sue you. They can't stop the sale of 2 and 3. But if 2 and 3 was held within one, everything stops at that point. So it keeps your business going if there's a potential issue. And the parent on a flip should be an S corporation, because everything will flow up to that parent, and then we can get around the Social Security, not entirely, but we can get around a lot of Social Security, the Medicare, and the local taxes as well.
Yeah. And I think in PA state law, when we're talking about like the lawsuits, if you have the property in your own name, I think it's 7 years that you're liable if they want to sue you. So if you're flipping a property, like I've seen people do it in their own personal name, and I'm like, you're crazy. Like you need to talk to an attorney right away.
And I agree. I would not do anything in your personal name, even if you have a business. Let's say you're running a retail shop and you want to buy the building. You don't buy the building under the business name, and you don't buy the building under your personal. Put it under another separate LLC, because if you don't salt that sidewalk tomorrow and it snows and they get hurt and they sue, if it's under your retail shop's now at risk. If it's under your personal, you're at risk. But if it's under a separate LLC where the only asset in that LLC is the building, that's the only thing at risk at that point.
Yeah.
And Dustin, we do that with trucking companies. Like we'll have trucking companies, the trucks will be under one LLC, the operations will be under another, the staffing will be under another, and the building that they own will be under another. That way, if they get sued for the trucking, the operations, they've got the trucking, the staffing, and the building. They just next day open another LLC for operations and continue.
Yeah. Good stuff. So we already kind of touched on that. So this mastermind is focused on real estate professionals. So we can let, pretty much agents, lenders, title, whatever, commercial agents, leasing agents, property managers, real estate investors, everybody's this is fair game for them to join. So it's very kind of real estate focused. What should everybody know about investing in real estate, and like the tax advantages and liabilities of being a real estate investor?
So generally speaking, on real estate, so people think and this is just kind of from even a meeting I had last week with a real estate guy. He just got into it. He's a physician, and he bought this property for like 50,000, and he's like, my taxes are going to be really low this year because I'm going to be able to deduct $50,000. That's the first thing he said. It doesn't work like that. What happens is there's this depreciation. And what happens with this is, so you buy a property. If it's residential, it's 27 and a half years of expenses. So that $50,000 house is depreciated or expensed over 27 and a half years. If that $50,000 property was commercial, it's 39 years. So one of the biggest things that people may, and it's more of just it's a wrong assumption, is that when you buy property, you'll be able to expense it right away. The other major assumption too on this is that when you make improvements to properties, not all the time is the improvements fully deductible. So if you put a new roof on a property you have, it's going to be depreciated over 27 and a half years. If they're a minor roof repair, you can deduct that as a repair. But your major improvement, so let's say you buy a property and it needs renovated. Renovations are not deductible right away. They're carried over that 27 and a half years. The big thing that I would say in real estate is, if you're buying a property and it's substantial, 250 more, talk to somebody about doing a cost segregation study. And what that is that's looking at a building and blowing it apart, turning that whole asset, so $250,000 property, into a 5-year asset, 7-year asset, 15-year asset, 27 and a half asset. So what they're doing is they're looking at your appliances. So out of that $250,000, what did you get with it? You got a washer, dryer, stove, a refrigerator, all 5 years, which under the current law, we can deduct that immediately. 7-year items, flooring, windows, you could deduct that immediately. 15 years, a lot of your landscaping, exterior items as well. And then the bones of the property, 27 and a half. So cost seg works, but it has to be worth it. Cost segs can be, I've seen them as low as $500. I've seen them as high as 20,000, depending on the property. So it's to understand, you pay that out, what are you getting in return? And remember, if you deduct $5,000, you're not getting $5,000 savings in tax. You're getting $5,000 times whatever your effective rate is. If it's 20%, you're saving $1,000. That's another kind of nuance with that. The other piece too is track your hours in real estate, because there's this thing called real estate professionals for what the IRS says, not professional licensing, but the IRS requires a yearly amount of hours being done. 750 is the amount. If you're over 750, you're considered a real estate professional for the IRS purposes. You might be like, what's important about that? It's how much you can deduct. So for me, I'm not real estate professional. If I have a property, and let's say I make $150,000 a year doing my job, but I have this property and I lost $20,000 last year on it, I can't write off a single dollar of that, because once I get to 125,000, this is household. So if you file jointly, your spouse's income plays into this. If you're single, just your income. But once you get to 25,000, you can only deduct $25,000 period. Once you get to 125,000, it decreases at 25,000 per dollar. So once you get to 125,000 $1, now you can deduct 24,999. Once you get to 150, it's zero. If I keep my hours though, and I'm making 150, and I can show that I'm a real estate professional for hourly requirement, and I have $25,000 of deductions, I can now take the full $25,000 deduction. Better yet, if I have 50,000, I can take the full $50,000 of losses, because I'm a real estate professional. The caps of the losses for real estate are removed if you qualify based off of the hourly requirement.
So for all of us who are already probably focused on real estate full time, that's a good thing, right? So what, to put that in simple terms, if you are like, let's say you're a factory worker during the day, and then you have one rental property and you're not putting a lot of time in that rental property, the losses of that rental property cannot reduce your tax liability on your personal income from the factory job.
If you're over that 150.
If you're over that mark. However, if you are working enough hours in real estate and you've got a full-time job, you can state that you're a real estate professional because you're meeting that hour criteria, and therefore you get the maximum ability to deduct based on your real estate losses.
And correct. And that hourly requirement can be training, education, reviewing properties, looking at properties, going and doing the physical work at a property, cleaning, maintaining, repairing. So keep track of everything, including travel time as well.
Yeah, so and that's huge, you know. So if you do start investing in real estate and you're not like actually active in real estate full time as a salesperson or whatever, you want to start tracking for sure that time that you spent finding the property and everything that Jason just mentioned.
And Dustin, one more thing on that too, you know, with the tax issues, you know, you Google this stuff and it's very vague. So when you Google like sell my property, capital gains, oh yeah, capital gains. Here's my rate. It's at the most favorable rates. It's not always true with capital gains with real estate because there's something called recapture. And what recapture is on properties, and what they call it is a 1250, section 1250, which is the building itself. So if you have appliances, recapture doesn't apply, but the building itself, if you depreciate, and depreciation again is that expense of that property over time, the IRS claws that back and makes that ordinary gains for purposes, it's called a 1231 gain. That's subject to the ordinary tax rates. And then the remaining amount of gains go into the either short-term or long-term being the most favorable. But it always creates a discussion when people are selling property. They're like, well, this is going to be at 15%. Some of it will, but not all of it, depending on the recapture of the depreciation.
Yep. So capital gains, you led us right into our next subject here. So how do capital gains work? So let's talk about capital gains on stocks versus capital gains on real estate, like a flip. What's the difference?
All right. So on stock, so there's short-term and long-term. Short-term is anything that's held less than 365 days or less. Long-term is anything that's held for 366 days or more. Why does that matter? Short-term will always be taxed at your ordinary rates. And the ordinary rates can be anywhere from 0% up to almost 38%. Long-term or long-term gains are taxed at 0, 15, or 20. And Dustin, knowing this question was coming, I cheated a little bit. I pulled up the table for this because I don't remember it. But for 2023, just to kind of give you an idea, on long-term capital, single, anywhere 0% is anyone that makes, and this is overall income, not capital gains income, but overall income, 0 to 45,000. Then 15% starts at 45,000, goes all the way up to $492,000. So if you're in that bracket, and you have a capital gain, you're at 15%. If you're married, that bracket goes from almost 90,000 up to $554,000 at 15, and then 20% starts after that. Now, for stocks, capital gains, either short-term or long-term, is based off of what you sell it for versus what you bought it for. So if you bought Google for $100 today, or at one point, and you sell it for $1,000 tomorrow, your capital gains is the 1,000 less the $900 capital gain. Now, in real estate, if you sell a property, you could be looking at same thing, short-term or long-term gains on that. But the cost basis is different calculation. It's not always as simple as what you bought the property for. Couple factors that come into what your cost basis on the property is: the sell price, all your closing costs, any improvements that you've done through it. Because remember, about 5 minutes ago, we were talking about certain improvements get capitalized, meaning you depreciate. So improvements, repairs that weren't expense but capitalized minus your depreciation then gives you what they call an adjusted cost basis. That adjusted cost basis is what's going to determine your overall capital gain, your sales less your adjusted cost basis. Now on a flip, if you seldom do a flip, you'd be looking at capital gains, either short-term or long-term. If you make a habit or a business model that you're constantly flipping, you're going to be under ordinary gains. And it gets people in trouble. We've had clients come to us because of audits, because they put their flips under capital gains, and IRS says, no, you're doing this as a business. This is not capital gains. They treat the flips as inventory. So you're selling inventory, which is an ordinary income.
And when you say ordinary income, that's like your job, right?
Exactly. Say tax the same way. And honestly, Dustin, if you're not an S corp in something like that, it's taxed the same way as your wages. You have federal taxes, you have state taxes, you have local, you have Social Security, you have Medicare. And on top of that, you have another Social Security and Medicare tax because you're also deemed as the employer on that.
Yeah. And that was one of the things where my first accountant will quote that because he wasn't really an accountant, but he recommended, as you've seen, I've got a LLC that is now a corporation. I have an LLC that's now an S corp that owns real estate, and the hang up there is that those capital gains, if we sell a property, they get taxed as ordinary income. Which means that we would pay, for me, I might be paying, 30%, 22% instead of 15%.
Yeah, 21%. Yeah, plus right now 10% on the state.
Yeah, which is, a lot of extra money that I don't want to be paying if I sell a property.
And then we can't even move it because then we have built-in gains too on the corporate side. So yeah.
Yep.
Yeah. Not to run this home on you, but C Corp's probably a bad thing to do in real estate.
Yeah, so get your tax advice before you start buying and selling properties, folks, and make sure that your accountant's actually an accountant. And
yeah, if you see C Corp and anybody ever acknowledges, hey, you should do this in a C Corp,
run.
Really ask why. I mean, there's certain C Corps that work. Like we have staffing companies where C Corps work for, but in real estate, seldom does a C Corp work. If you have a C Corp that manages your contractors and it's billed separately, okay, maybe, but not to hold property.
Yeah. Because
there is no, as Dustin was saying, there is no capital gain rate for C corporations. It's a flat 21%. And that was something that came under the 2018 tax rules. Prior to that, it could be all over. It could be up to almost 40%. And state of PA, they're going to start coming down in the next couple of years, but they're at 9.99%.
Well, yeah, and if I were to do that, I'd have to pay that. And then if I actually took a distribution, I have to pay income tax on it too, right?
Yeah, you take dividends.
Yeah,
and then your tax. Yeah,
that's double on that. So.
Yeah, C corps have double taxation. So as Dustin was alluding to, he sells, unlike your pastors, your S corps, your partnerships, your single member LLCs, where you as the owner pay the tax. On a C corp, the C corp pays taxes on the income, not the owner. But then if the owner gets any money from the company, it's treated as dividends, which are then taxed again. So in essence, sorry, Dustin, sorry to beat this up on you, but he could be looking at 50% taxes on some of this because he's got 15, potentially 20% on dividends, another 3% on the state, 10% on the state on the corporate side, and 21% on the federal side.
So that's learn from my mistakes, guys. That's why we're here. learn from others, so you're not repeating what we've done. So we're going to open this up for questions. Who has questions for Jason? What would you like to know?
Jason,
hi.
Oh, I'm sorry. Go ahead, Anthony.
We'll go Jason first.
Thanks.
Jason Conlon, go ahead.
Jason, I just had a real quick question. As somebody that just basically sells real estate, I don't do any kind of flipping or anything like that. Is there anything in particular, other than what like Dustin said, if I take a client to get coffee or something like that, that I should really be paying attention to tax wise?
Yes. Yeah, so on that, the mileage to and from, if you work from home, if your office is from the home, then your mileage from home to that coffee shop is going to be deductible, and the mileage from the coffee shop back home is going to be deductible. Always keep logs. The IRS wants mileage logs that have the beginning odometer, ending odometer, and there's actually apps that'll do this already. They'll run a GPS off it to track the miles directly, and always list who you met and the purpose of the business purpose on there. As far as the meal itself, you just want to, on the receipt or even a documentation with the IRS used to be really big on receipts. Now with you look at the bank statements we get now, the credit card statements, they list everything. Like, exactly where you're at with the credit card and the bank statements. We have clients that just write next to the statement who they saw, they keep that as their record. But you want to make sure that you document who you see for proper documentation on that. And Jason, I would say too, if you are, being a real estate agent, you should look at potentially, if you're not already, an S corporation, because you get creamed on Social Security, Medicare twice, local taxes as well. And if you're the only employee in your company, you can do a profit share. There's a bunch of different tax advantages to do too if you open it up to an S corp, because under an S corp you have to become an employee as well for the company.
Thank you so much.
You're welcome. You're welcome.
Yeah, and I always recommend for agents, like if you're making like over 30 grand a year in commissions, you probably should be opening up an S corp.
Yeah, Dustin, that's right on. We say between 25 and 40,000. That's where that sweet spot is, because the payroll that you have to processing that you have to pay, plus the additional tax return, that's where you start seeing a savings if your income's between 25 and 40.
Yep. And what about home office? Like if he's got a home office, he can write off like a portion of his home repairs and stuff, right?
Correct. Landscaping can be, because everything that goes into your home, a portion, not all of it, a portion of that becomes deductible. Now on an S corp, you lose the home office as you know it. You write it off on your Schedule C if you're a single member LLC. But what we do on an S corp is we make you rent the home office to the S corporation. So the S corp pays you rent, you record that rent as revenue, and then you take a pro rata allocation of the expenses against that rent on your Schedule E.
Good stuff. Anthony, you had a question.
Can you hear me?
I can, yes, Anthony. Hi.
All right, sorry, Jason.
That's all right.
So I currently have a 401k plan through my employer. Upon my exit, in probably a year or so, I'd like to roll over to a Roth IRA. Can you explain the big differences between the two?
So on a Roth, so on a 401k, that money is put in pre-tax. So you don't pay any taxes on that. Now you do pay Social Security, you do pay Medicare. State, you still pay state taxes and you still pay local. The idea is when you cash that 401k in or start taking distributions when you retire, you'll pay federal taxes then. A Roth, though, you put it in as post-tax. So when you take the money out from a Roth, there is no taxes when you take it out. The issue that you're running into is you're converting one from a pre-tax to a post-tax.
Right.
So what they do is they'll tax you, but you can choose to elect to take that tax over 2 years. So
Okay.
1 year, so let's say it's $50,000. You can elect to choose to take 25,000. You'll still take all of it all at once, but it's how you report. You'll report 25,000 in the year you initially take it, and another 25 the next year. And the idea is just to spread those taxes out. Now, this is where the tax planning comes in. If next year you think it's going to be a lower income, you may want to take that full amount next year when your taxes are lower, instead of taking half of it in a year that the taxes are higher. Because remember, for federal purposes, the more you make, the higher that tax rate. So it's not a simple answer just to say, oh, well, take it over 2 years. You have to look at what you expect in that second year versus what you're making in the first year.
I didn't think about that actually. Yeah, okay, that makes sense.
Yeah, it's like, so for instance, like we'll get clients that'll call and say in real estate, hey, I'm going to take some of my retirement out to buy this property. And I'm like, and sometimes it's like 100,000, 150,000. Like, how about this? Why don't you take 75,000 out this year, take a loan for the difference, then take the remaining amount out next year, and then pay the loan off. And the reason being is that that difference between 75 and 150 sometimes can be 10% extra. So you could save $15,000 by just taking it over 1 year, rolling year, but just not in the same calendar year. Like we had one woman, she wanted to pay her daughter's student loans off as a birthday gift, and her birthday ran in December. I'm like, how about take half now and tell her that the other half's coming, and then on January 3rd she took the rest out, and by doing that her taxes went down $8,000.
That's crazy.
So I think I've told Dustin this. Anyone truly with the software can do the tax return. That's the easy part. The big part where I make my money and what I'm good at is the tax planning piece, is to look at that and say, Anthony, yeah, I know you're going to roll this over, but maybe you want to take all of it now as taxable, not carry it over for 2 years, because of, you might be saying, I'm planning on making $400,000 next year or 2 years from now, where we would push that into a 40% tax bracket versus paying 20 now.
Yeah, huge difference.
Yes.
Couldn't he roll it over into just a regular IRA also to avoid paying the taxes on it?
He could, yes. But if he does do a Roth, there's a conversion there. Now, Anthony, if you roll to a regular IRA is still a pre-tax, so no taxes on that conversion, but you'd pay the taxes when you retire.
Okay.
And you could even do a mixture of both. You don't have to do all into one.
What's the max contribution for the Roth or the traditional IRA?
A traditional IRA is $6,000.
Okay.
But yeah, what do you do now?
I'm quality assurance. I'm getting the real estate license.
Okay.
But right now I'm quality assurance for Hershey Company.
Gotcha. Are you planning on a real estate agent?
Yes.
What you may want to do is if an S corp works for you later, in a year or two, what you might want to do is roll into your business's 401k. Start a 401k under your business and roll it into there. And then that way, what you could do as an employee, you can contribute, and then you could do this thing called profit share. So, so let's say you make $40,000 wage, your company can put in another $10,000 to you as profit share. It's not subject to Social Security. It's not subject to Medicare. The big part of that is this works well if you're going to be the only employee, because if you are not the only employee and you hire other people, you have to share that profit share. But if you're the only employee, you could do a profit share.
Huh.
So,
nice.
Yeah.
Nice.
Yeah, we had one guy, a trucking guy. He hired his son, and we did some things, and we made him a consultant, not an employee. And the reason being is the father was sitting on a lot of money this year, and we needed to do some kind of late tax planning, because the guy cashed checks it. I'm like, don't even invoice this money yet. Wait, because it's going to put you in another tax. Well, he did. So like 3 weeks before the year's ending, we're running around trying to fix this. And what we ended up doing was creating an S corp for his son. The company hired his son, paid him $220,000. We did a wage of $160,000. He puts 20 grand in to the 401k. Then the company gives him a profit share of $40,000. So he maxed out the overall retirement of $60,000 last year, but it saved him like almost 20 grand in all these taxes by doing so. So yeah, profit share works really well if you're the only employee. If you're not the only employee, you gotta share it.
Right.
But in real estate, most of the time you're going to be the only employee. And the other thing, if you're married, what you could do too is, or if you got a partner and you trust that person, you can make them an employee. Now, I'm sorry, let's say married, because if you're married, you can do these 401 solo, which is cheaper to run. And it's not to bore you with the particulars, but it's called rules of attribution. You being married, it's as if your partner owns the business as well. because of the relationship. You
Right.
can hire your spouse, pay them, say 20 grand, and earmark all that money to 401k. And
Okay.
it's deemed for purposes of retirement that you still only have one employee because of the rules of attribution. And we like to do that, like if the spouse doesn't work and the business owner wants to maximize retirement to the fullest, we'll hire the spouse, as admin, cleaning files or whatever, and
Right.
just max out the retirement through the wages.
Cool. Very interesting.
There's a lot of gray area in accounting and tax, and it's just you just got to think out of the box sometimes on this stuff. But the rules are there. You just gotta utilize.
Yeah, work within the rules that they give you. So Helen asks, if she's studying for her real estate license but does not plan on working in the field this year, is it still considered a startup cost?
Not until she actually starts doing the work.
Okay.
But as I was saying earlier when we started this, don't get rid of those expenses. Keep those expenses, because when she does start next year, she can use that as startup costs. But that would, and also if that training means she's traveling out of town, flights, hotels, keep all of that, because that's all going to be part of the startup costs.
Okay, good. What else? Anyone else have questions?
Yeah.
Go ahead, Dwee.
Okay, so I just kind of want to do like a quick recap on the S Corp. So right now I'm a new wholesaler, right? And let's say if I end up grossing 100K this year, decided to select an S Corp and pay myself 40K, the government can take that cuts. So the remaining 60, I can just pretty much write myself a profit share check for 60 grand and be cool with taxes on that 60, or
A little bit more than that, but on the 40, we run that through wages. On that 40, that's going to be subject to those 7 taxes. If you're in the state of PA, you're going to have the PA local, you're going to have the PA state withholdings, you're going to have the Social Security, you're going to have the Medicare for you as an employee. Then your company's going to pay their share of the Social Security, they're going to pay them their share of the Medicare, then you're going to have federal. The remaining 60 then comes to you only taxed on the federal and state. There's no Social Security twice, there's no Medicare twice, and no local. But that 60 doesn't become tax-free. It's just it eliminates 5 of the 7 taxes. So federal is taxed on it, states, but there is no local on that 60. There's no Social Security and there's no Medicare.
so can I just write myself a loan check for 60 and avoid that, or I'm just thinking
Well, the distributions itself aren't technically an expense to you. So if you have 100,000, you net 100, you pay 40 in a salary, and we'll forget about the whole company side of the payroll taxes. We'll just say it's 40 straight. So bottom line 60. When you get your K1 for the S Corp, it's going to say you made $60,000. Now you could take that full $60,000 out. It'll still be taxed though when you file your personal tax return, but you can write yourself a distribution check for $60,000. But by writing the check though, it doesn't mean that it's an expense of the company. It's just you taking the profit of the company, and that profit is going to be taxed. Does that, it's a complicated concept, because technically itself, distributions are not taxed. It's the profit that's taxed. But where do you get distributions? From the profit. So they're theoretically still taxed, but it's a 60, pulling the 60 out of the company. Or better yet, here's another example. Let's say the company makes the bottom line $60,000 and you leave the $60,000 in the company. What are you taxed on? You're taxed on the $60,000. Second scenario, company makes 60, you take the full $60,000 out, you're still taxed on the 60. Now, on the first scenario, if you leave that 60 in, and then let's say the next year you do absolutely nothing with your company and you pull that 60 out, what's your taxes the next year? It's 0, because you've already been taxed on that 60. So it's the bottom line of the company that you're taxed on, not the distributions. Does that help?
Yeah, yeah, that's,
I mean, I can,
I
if
haven't
you
made it
need,
that far yet,
oh,
so it's
gotcha,
good to know. So if I do make it that far, then yeah.
gotcha.
Yeah, and you can like what we were talking about with Anthony too. If you've got that S corp set up and you wanted to pull that 60 out, but you didn't want to pay taxes on all of it, you could have a 401k or a SEP IRA or something like that set up where you're putting part of it into there and you're avoiding the taxes for now. You'd have to pay the taxes later when you pull out for your retirement. But if you didn't need the full 60, that's a way to take it and defer taxes for a long time on it, where you put some of it there and then you pull some out as profit.
The other thing too is that we're talking retirement, but also healthcare. Have the company pay for healthcare. If you're the only employee, like I was talking to Anthony before, and he starts the S corp and he's got to pay healthcare, best thing to do is let the company reimburse you. You go out, buy a plan, and just create a small little policy that's a reimbursement plan. The company writes you a check every month for that. That becomes fully deductible through the company as an employee benefit. And then if you have a high deductible, have the company contribute to an HSA. So again, all these, it's not much, but all these things combined start putting together a good tax savings plan. Especially if you got to buy healthcare anyways, let's at least get it set up so we can take the deduction on it.
So would like life insurance be a part of that deduction if?
So life insurance is not though, because here's the thing with life insurance. Life insurance is not taxable, only the interest earned on a policy. So because it's not taxable, it can't be deducted either.
Good to know.
So, but I like your thinking. I like your thinking.
Yeah, maybe he should work for you.
I agree, yes.
I'll actually run some stuff by Dwee before I bring questions to Jason next time, so I have some good ideas.
I like that.
All right, who else? Somebody else had a question.
I had a question mainly about record keeping and how to best be prepared at the end of the year, how to bring everything to you, like if you offer any kind of consulting about, for example, I use Simplify or QuickBooks, or bookkeeping software. I'm always scared that I'm not categorizing everything properly, or do we just give you our best shot and you
Give it the best, honestly, give it the best shot because we're gonna look at it. It's our job to look at it. We don't audit, but I do look at it. And I will tell you, and it's probably bad of me to say, but classifications, let's say you bought materials. Actually probably bad thing. Let's say you buy office supplies and you put it in by accident as telephone costs.
Right.
IRS don't care because frankly, it's still going to be deductible. The issues that you get into is with these things is when you run into if it's meals, if you reclassify meals, because meals you can't fully deduct, it's 50%. Or if you have repairs, it should be capitalized. But we look at those things, but definitely do your best shot. We offer bookkeeping, but sometimes it can be expensive. So in accounting, you always have to weigh the cost versus the benefit as well. So, but if you got everything in QuickBooks and you give us the bank statements, we're going to look at it. That's not to say we won't miss certain things because again, we're not auditing, we're sampling things, but I know the industry averages. So like if you're a real estate professional and you have mills that are $20,000 and you made 200,000 last year, I'm going to question that because it's so out of the norm. So we're looking for those, and also there's audit guides for the IRS that I'm looking at too that say this should be the threshold. So I'm looking at those audit guides as well and looking through those thresholds because those thresholds, what they do is they'll audit companies and industries not to see if they're doing anything wrong, but to gauge what these industry averages are. So there's these different audits. They're like, we think you did something wrong. And then there's these audits the IRS does. We're not looking for anything wrong. We're looking for your industry averages. And that helps them with auditing in the future. So using those industry averages, we can catch a lot of things too.
Good. Does it look the same when they contact you and say they're auditing you? Do you know the difference?
They do, actually, they look identical. Yes, they do. Because it's just, I don't know why they do that. But yeah, it does look identical. And speaking of audits, I know everybody fears an audit, and maybe it's just I've been immune to it because I've been doing it so long. Don't worry about an audit if you've done everything right. Because if you've done everything right and they find out they wasted their time, they're not bothering you for 6 years. So it's like, hey, you're off my back for 6 years. I had a corporation audited about 2 years ago. They found out that they actually owed, the IRS owed them like $5 grand. And I told the owner, said, you're off the looking for about 6 years now. Not to say that's open season. I want to be clear. Not to say that's open season to do anything you want, but they're not looking at that point because they wasted 3 months on this client.
Tax dollars.
Yes.
Put to good use.
Yeah.
All right, any other questions?
I think there was one about, do we work with anyone in Florida? We do. That's a lot of companies actually in Florida.
Yeah. So we will share Jason's information with everybody in attendance and everybody who wasn't in attendance today as well. I'm going to do kind of last call for questions. Anyone? And we'll talk. Justin, you got a question?
Yeah, Jason. Yeah.
Hey, Justin.
Hey, how you doing?
Good. How
Hey,
are you doing?
Good. So I'm a real estate agent, and I was just wondering, like, do you ever just do like one-on-one meetings where I could just kind of just like talk to you about this
pick
kind of
my brain?
stuff? And
Oh, absolutely. Yeah, we actually offer an hour free all the time.
Oh, sweet.
So yeah. So I think Dustin's going to send you share my email and stuff. Just reach out.
Perfect.
I normally, just because of tax season, I'll send your email to Laura, who's another business partner, but she kind of keeps me in line. So she'll just say, hey, what's a good day? And we'll do a Zoom or something. Because
Awesome.
honestly, if you wait for me to schedule, I'll be like, oh yeah, let me know. And then it's better if she handles it. So
Okay, perfect. All right, awesome.
I know where my weaknesses are, and that's my weakness. So,
Yeah. Okay, great. All right, awesome. Thank you.
You're welcome. You're welcome.
All right, guys, thank you. So thank you, Jason, for joining us
welcome.
today. We appreciate it. Reminder, next month, so we do this the second Wednesday of the month every month. Next month, we do have Dan Constantino joining us. Dan is a real estate investor who owns something like 400 plus rental units at this point. When I first met him, he only owned a couple, and he had a full-time job in corporate America and decided that he was done with that. So he's made a huge transition in just a few years, and he is currently running syndications essentially. So he raises money and he buys rental units. So he will be joining us to tell us all about how he does that and answer any questions that you have. So please be here for that. If you have anybody you'd like to get to this mastermind, or you think would be interested in the mastermind, please share the registration. We're happy to have anybody that you refer, even if they are not real estate professionals. If they're a friend or family member of yours, they are welcome here. So thanks again, everyone. I'll get the recording out here within the next week or two, and we'll get Jason's contact info out, and we'll see you again next month.
Thank you, everyone. Have a great evening. Dustin, thank you.
Yep, take care. Thanks.
Guys. Thank you. Bye.